Hello and welcome to Signals and Noise, where strategists and economists from around the globe offer a shorter take on markets and economic matters. This is as a part of the Global Research Unlocked series. I'm Mark Cabana. I'm co-head of Global Rates Research, and we're recording this episode around midday Eastern Time in the US on July 27th, 2026. And we're recording right now on the eve of what is a very highly anticipated July FOMC meeting. It's not just anticipated because it's one of the 8 times a year that the Fed meets, but it's also quite unusual because the market has an elevated sense of uncertainty going into this particular meeting. The rates market is pricing roughly 9 basis points of hikes for this meeting, or a roughly 35 to 40% chance that the Fed will move rates higher when they meet on Wednesday. This is unusual because the Fed normally signals what their intentions are ahead of a meeting so as to not have the market guessing and also to not have a large amount of volatility on any rate decision. We've got a new Fed chair, Chair Warsh, who has said that he does not want to guide the market. Rather, he wants the market to inform policy decisions by pricing what they think the Fed should do, and then the Fed can ultimately take that as an input into their decision-making process. So we're going in with a market that is roughly 1/3 probability expecting a hike and 2/3 probability expecting a hold. So what do we think here at Bank of America? Well, our house view is that the Fed will be on hold at this meeting. We will see 2 dissents in favor of hikes. That will be from regional Fed presidents Logan and Hammack. And we will then see the market just push out the expected hikes and maybe take down the total amount of hikes that the market is pricing to some extent. But we, as a research team, are not willing to completely rule out the possibility of a hike at this meeting. We think there are plenty of good reasons for the Fed to consider such a move. Those reasons include, first, that the Fed has been missing its inflation target for roughly 5 years and is not expected to get back to target probably for 6 or 7 years. 2, underlying U.S. economic data seems resilient. This is true from a growth perspective, a consumer spending perspective, and a labor market perspective. 3, you've got very easy financial conditions, in our opinion. 4, you've got upside risks to oil and other commodities, depending upon how geopolitics evolve. And 5, you have heard a notable shift in Fed speak, where they are sounding increasingly inflation impatient, at least to us. Now, history tells us that especially when the Fed hikes, they don't like to surprise. In analysis that we have done using Fed funds futures and OIS pricing back since the mid-90s, to us, we conclude that really the market typically prices in a minimum of a 60% probability of a Fed action, and oftentimes more than 90% probability of a Fed hike. Now, what will happen to the market if the Fed decides to hike? Well, as we wrote in our most recent Global Rates Weekly, we think that if the Fed were to hike, we would expect market pricing for the end of 2026, which is roughly around 45 basis points right now, to reprice towards 60 or more basis points of hikes just in this year. And for the cycle on the hold, the market is pricing about 55 basis points of total Fed hikes, and we think that could go to closer to 70 basis points of total hikes overall. So you would see a pulling forward of the timing of hikes and an increase in the total amount of hikes. Now, questions that we get are, well, that's fine at the very front end, but what about at the very long end? We believe that if the Fed is hiking this week, you will see the curve flatten, and you will likely see long end rates go down, not up. We think that long end rates will go down as a result of the fact that, first, higher rates will have a little bit of a headwind for overall economic activity. Second, you should see inflation risk premium go down. So 10-year break-even rates of inflation are just about 2.2% as I see them right now. I would guess that goes lower if the Fed is hiking this week. And I might also guess that risk assets wobble a little bit. So they do think that there would be a bit of a risk asset move on the back of this. And we do think that that would help push long end rates somewhat lower. Now, our forecasts for the 10-year and the 30-year at the end of the year are 4.5% and 5% respectively. That's roughly 15 basis points lower than where we are at the moment. So a surprise Fed hike this week would put upward pressure on front end rates, it would flatten the curve, and it would also move back end rates closer to our end of 2026 targets. So overall, it's a very exciting week for us in the fixed income markets. It's a very unusually uncertain Fed meeting that we are moving into, and it is one that has the possibility of creating a new historical precedence if the Fed indeed hikes with such little that is priced. So that's it from me. I hope you enjoyed this shorter take on markets as a part of the Global Research Unlocked series. And if you're a client of ours, you should feel free to reach out to us anytime for additional perspective and hopefully what you will find are useful insights. Thank you all for listening.
Bank of America and B of A Securities are the marketing names for the global banking businesses and global markets businesses, which includes B of A Global Research of Bank of America Corporation. Lending, derivatives, and other commercial banking activities are performed globally by banking affiliates of Bank of America Corporation, including Bank of America N.A., member FDIC. Securities, trading, research, strategic advisory, and other investment banking and markets activities are performed globally by affiliates of Bank of America Corporation, including in the United States B of A Securities, Inc., a registered broker-dealer and member of FINRA and SIPC, and in other jurisdictions by locally registered entities. Copyright 2026 Bank of America Corporation, all rights reserved.